Hi everyone, so today we're going to be doing a new company. It's called ServiceNow. This is going to be a stock analysis video, so let's get right into it. I'm going to go ahead and share my screen and we're going to do a complete analysis. So of course, starting off is what does the company actually do? And they're similar to, I would say, Monday.com, which is their data management HR tool. So just specifically, you can see ServiceNow provides a cloud-based platform for creating and automating digital workflows across an entire enterprise, connecting departments like IT, HR, customer service, and security to streamline operations, improve efficiency, and enhance customer employee experiences by managing request processes and data in a single system. They use AI low-code tools and a shared database to make workflow better. They manage IT support, automate IT infrastructure, streamline HR onboarding, IT support, customer service, improves customer service with AI-powered virtual agents. So pretty much, I don't want to just go over the same thing over and over again. They are a data management company that just helps manage the company extremely well. Like I said, Monday.com is a pretty close example of that. So now we're going to check something I actually wanted to share, and I think it's important, their market share. Their market share, I was looking this up, is quite interesting. So they're actually the dominant market leader in this specific, they're technically a software company, I believe software infrastructure, and they are in the IT services management. That is where they're a dominant market leader. They hold a significant chunk of that market, which is about nearly half, or 40 to 45% of it. Let's just round it up. I think it's like closer probably to 50%. So almost half of the this market specifically, ServiceNow is doing very well in. However, they're saying here, while its overall software market share is much smaller, around to let's say 1% to 2.5% compared to giants like Microsoft and Oracle and broader market categories, its strong position is due to this broad features like high customer satisfaction, expansion to AI, and other workflows, positioning it as a leader in IT operations, asset management, and security. So I thought that was actually really interesting. So yeah, they're holding over 40% of the market, some citing 45% in 2024, and some even 50%. So I think it's super cool. And again, some of the competition are Atlassian, BMC Software, Microsoft Salesforce, things like that. But I think Monday.com is also in that as well. But regardless, we have to see how they're doing financially. So the next thing that I need to share is their earnings. And their earnings are, I would say, overall pretty good as well. So for Q3 2025, this is the most recent earnings. Revenue actually grew 22% year over year to $3.41 billion in subscription revenue. That's their main source of revenue, subscription revenue, as you could imagine. Which makes up most of sales, growing by 21.5%. So good to see as well. And however, they are predicting that, of course, this company is massive. It's tens of billions of dollars. So it's already a very big company. And they're saying probably by 2026 onwards, they're going to grow around 15 to 18% annually. So obviously growth is slowing, especially at that level, just naturally going to grow or trend a little bit downward slowly, but definitely surely. Strong performance, reported 3.41 billion in Q3 2025, beat analyst revenue. AI is a driver, really good to see, and they raised the outlook. Full year 2020 subscription approximately expecting approximately 20.5%. So I think that's good to see. I think all the metrics are good. So this is just, I just wanted to see the full year guidance. It's pretty much the same thing as I was saying before. And it looks like they actually approved a 5-for-1 stock split as well. So great to see, and that happened December 17th as well. So I think overall the company looks pretty good. It has had quite a bit of a sell-off, so keep in mind of that. Now, we need to see something a little bit more specific, which are, of course, the numbers to see what's happening. And it looks like here it's close to a double, 3.9 billion free cash flow, next 3 years, 6.5 billion. So it's close to a double, but not quite. And of course, that's reflected in, their growth in revenue is certainly slowing down, like I said before. The financial health, though, is very good. I would say minimal debt, good amount of cash, good amount of equity. So really no complaints. It's really good overall, I would say. And it looks like the debt has been trending slightly downwards over the past couple of years. So that's also good as well. So we're going to see if this is over or undervalued. And it is saying it's undervalued by 77%, which I do agree with, because it's having 23% historical growth, Wall Street forecast. Even if we use it at the more bearish side, 13% is still undervalued by 65%. So 65 to 73% undervalued. I do agree with that, because Tipranks is going to actually stay that it is 48% upside, strong buy, 28 buys, 2 holds, and 1 sell. Keep in mind that they have had quite a sell-off, even this past month, but I think they could be on quite a trajectory upwards, because they are a really good company and their earnings are quite solid. So I would not be surprised if they have a significant rally in 2026. Okay, everyone. Thank you. I appreciate it.